3. The aftermath of the financial crisis. The 2008 financial crisis had profound and lasting effects on the global economy, financial regulations, and public perception of the banking industry. Economic impact. The global economy contracted sharply in 2009, with advanced economies such as the US and the Eurozone experiencing severe recessions. Unemployment rates soared as businesses slashed jobs to cope with reduced demand. In the US, the unemployment rate peaked at 10% in October 2009, while global GDP shrank by 0.1% in 2009. Bank failures and mergers. Many financial institutions failed or were forced into mergers to survive. In the US, Washington Mutual, the largest savings and loan institution, collapsed, and Merrill Lynch was acquired by Bank of America. In Europe, major banks like Royal Bank of Scotland and Lloyds TSB required large government bailouts. Regulatory reforms. In response to the crisis, governments and financial regulators enacted reforms to prevent a similar meltdown. In the US, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law in 2010. It aimed to increase transparency, reduce risky financial practices, and improve the regulation of financial institutions. Key provisions included the creation of the Consumer Financial Protection Bureau (CFPB) and the Volcker Rule, which restricted banks from engaging in proprietary trading. Public outrage and Occupy Wall Street. The crisis fueled widespread public anger towards banks, financial executives, and government bailouts. Movements like Occupy Wall Street emerged, protesting income inequality, corporate greed, and the lack of accountability for those responsible for the crisis. Quantitative easing and central bank actions. In addition to cutting interest rates, central banks, particularly the U.S. Federal Reserve, embarked on an unprecedented program of quantitative easing QE to stabilize financial markets and encourage lending. The Fed purchased large quantities of government bonds and mortgage-backed securities to increase liquidity in the economy. Slow recovery. The recovery from the financial crisis was slow and uneven. While financial markets rebounded relatively quickly, the broader economy took much longer to recover. Millions of people lost their homes due to foreclosures, and income inequality widened as the financial sector recovered more quickly than Main Street. In Europe, the crisis morphed into a sovereign debt crisis, particularly in countries like Greece, Spain, and Portugal, which faced severe austerity measures as part of international bailout programs.